Hello, Michael Scofo here, one of the partners with Fortress Wealth Planning, and today I want to talk about Roth conversions and why they can be an invaluable tax strategy when thinking about your lifetime tax planning. If you've worked at all with our firm or have had conversations, this is likely something that has been brought up in one of the conversations over time. So let's start with what is a conversion. A Roth conversion is the idea of taking pre-tax dollars and converting them to tax-free dollars, Roth IRA. Now, those funds could either be inside a 401k, a 403b, or a traditional IRA, for example, and they would be converted to Roth, which would become tax-free. Now, any dollars that are converted in that tax year would be added to your other income and be taxed at ordinary income tax rates. Now, why would we do this? The idea of taking and prepaying the taxes today and letting the money, the converted dollars, grow tax-free, the compounding effect of all that tax-free growth over your lifetime to then be withdrawn without tax has a massive, or could have a massive, compounding effect on one's financial situation. It doesn't work for everybody, but in many cases it does, and it can have a significant impact. Now, the recommendation oftentimes is the taxes related to the converted dollars should not be paid out of the converted proceeds, but should be paid out of other resources, other cash, or other investment dollars. That just something to be aware of. There is something that is known as a backdoor Roth conversion. Now, if somebody wants to make a direct Roth contribution in 2024, they are limited as a single filer to a modified adjusted gross income of $161,000 before they are phased out. For a married couple, modified adjusted gross income over $240,000, they're phased out. Now, they do have the ability to employ what's called a backdoor Roth conversion, which is a bizarre name, and it is something that is acceptable in the eyes of the IRS. That just happens to be the name of it. Here's how it works. You take after-tax dollars, you contribute them to a non-deductible traditional IRA, and then they are immediately converted to the Roth, and therein lies the backdoor Roth conversion strategy. Now, there are some nuances with this. For example, if you have a traditional IRA, there's something that's called the aggregation rule that should be taken into consideration. If you're working with us, that is something that we'll absolutely work around and maybe not even recommend the backdoor strategy if it doesn't make sense. If you have all of your retirement savings inside an employer-sponsored plan, the aggregation rule does not come into play, but just something to be aware of. Taking it a step further, I want to show an example of a mega backdoor Roth conversion. So as an employee in an employer-sponsored retirement plan, we'll just assume in this example, the individual is under 50, and in 2024, they can make a $23,000 employee contribution to the retirement plan. Those dollars, the employee contributed dollars, could either be pre-tax, known as Roth, or pre-tax, or also the Roth, if the plan allows for it. In this example, in the gray bucket, we have the employer match, which we assumed in this example was $9,000. But there's something that many plans offer, and we find that a lot of folks aren't aware of, and that is the idea of an after-tax or a post-tax contribution bucket. The IRS limit in 2024 for an under 50-year-old is a total contribution of $69,000. So let's walk through the math. As an employee, we contributed $23,000 to either pre-tax or Roth. In this example, we assumed a $9,000 employer match. And the difference between those two numbers and $69,000 would be $37,000 that could go into this after-tax bucket. Those dollars could be converted to Roth, and therein lies the mega backdoor Roth conversion. So if you have a 401k, 403b, or the like, This is something that should be considered or at least explored. Happy to walk through it with you. Doesn't make sense in every situation, but it is something, if cash flow allows, your financial situation allows, that should be considered, and one that we would recommend. Talk about conversion strategies for business owners, sticking with the idea of a mega backdoor Roth conversion. Business owners, when we're designing a plan, and in this particular case, it's a solo 401k, so for one individual, when we're designing a plan, we make it very friendly in that you have the ability to either contribute as pre-tax or Roth. Stick with the same under 50-year-old example, $23,000. We would build it that it allowed for this post-tax or after-tax voluntary contribution bucket. Total maximum amount is $69,000 for 2024. You subtract $23,000 from that number, and that allows an additional after-tax contribution of $46,000. That amount would be converted immediately to the Roth portion of the retirement account. Therein lies the mega backdoor conversion again. If you have employees or a multi-participant plan, we would build this slightly different to allow for the ability to incorporate this. There's some nuances, but we would work with you in talking through that. So let's talk through some considerations. Why would we consider a standard Roth conversion? Why would we consider building up a bucket of Roth dollars through a backdoor, a mega backdoor Roth conversion technique? And the reason is current versus future tax rates, depending upon your situation. Will you be in a higher tax situation down the road as you are today? Or do you have a view on where taxes are going? Maybe you have a strong conviction around what you feel will happen in the tax environment. Anyways, the issue is prepaying the taxes today and alleviating any tax on the growth for the remainder of your life. There's something that's also called a widow tax. Now, if you're a married couple and you have required minimum distributions at some point in your life, depending upon your age, you will have these required minimum distributions coming out of your IRA or your qualified plan, and that will be added to your current income and taxed at ordinary income tax rates on top of your Social Security and any other income that you may have out there. When you're married, the tax brackets are wider and you get a higher standard deduction. When you're a single filer or a widow, the loss of a spouse, the brackets are compressed. So you bump up into the next highest tax bracket sooner, and therein lies the widow tax. If you have a significant gap between, or age gap between spouses, this prolonged higher tax environment could go on obviously much longer and have a significant impact over one's lifetime. Succession planning would be another reason. So we find that in many situations, families won't even consume their qualified or retirement dollars, and these are dollars that will be left to the next generation, either by default or maybe by design. And the idea around leaving behind tax-free dollars for the next generation is appealing to many folks. It could be considered like prepaying a gift. So you are limited during your lifetime or at your passing on how much money you can give without paying tax on the gift. And the idea behind prepaying taxes by converting pre-tax retirement dollars to Roth could be considered a gift if it's part of your legacy or estate planning objectives. Changing regulations could impact why you would consider a conversion, and just being very thoughtful on how to plan around your lifetime tax bill. Let's talk about the power of a conversion. So the idea is that you potentially lower your required minimum distributions because you have less in pre-tax and some in Roth, or maybe even completely eliminating it if you did a full conversion. Again, prepaying the inheritance tax. You're gifting the dollars, so to speak, today by paying the tax and allowing that money to grow tax-free. The other consideration around legacy planning is that whatever is left over in a retirement account, when it goes to your heirs, there's something that's called the 10-year rule. And the balance of those accounts will come out over 10 years. So if it's pre-tax and they inherit that IRA, your heirs over 10 years will be required to deplete that traditional IRA, and that income will be added to their income, potentially creating a larger tax bill than they anticipated. And then again, lower lifetime taxable income. People are living longer, and so the impact of growing dollars and never having to pay tax on them again can be very powerful and appealing. Let's talk through some conversion myths. So conversions only make sense in the fourth quarter of each year. Not true. Converting in a down market can be very powerful. So if we're inclined and on board with doing a Roth conversion, we might accelerate that if the market pulls back, right? Because you now have an IRA that is at a lower value, could be converted and recover inside the Roth. We do take some very methodical and careful planning when considering a conversion and the timing of such, taking into account your overall tax situation. The next myth would be conversions are only or not viable when you're in the highest or lowest tax brackets. Not true. We find that in many, many situations, a conversion makes total sense, even when folks are at a high tax bracket. Time is your friend. However, the emotional thought of having to pay the IRS more tax than you've already paid them tends to be a block for many folks. We understand it. We get it. Nobody wants to pay more tax. But when you look at and do the math around the compounding effect of never having to pay tax on that money again, either during your lifetime or your heirs' lifetime, there could be a very powerful argument that it does make sense. Not everyone, not one size fits all in any of these situations. It's why it's important to review your situation and whether or not this makes sense, depending upon your goals, your tax situation, your ultimate objectives. If you'd like to talk about this in greater detail, we'd encourage you to click the blue button at the top of your screen on the right-hand side and schedule a call, or feel free to forward this on to anybody in your life that you feel could benefit from a conversation. We appreciate you spending some time with us, and be well.